Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged. Thanks so much for tuning in today. I know how valuable your time is, so I appreciate you spending some of it here with me today. Now, on today's show, I'm talking to Nigol Koulajian, founder and CIO of Quest Partners. Originally of Armenian background, Nigol spent part of his childhood in Lebanon, but by the age of 16, he moved to the US to escape the wars around him. The uncertainty he had to live through as a child has clearly influenced his approach to life and later on the way he designed his trading strategy. In a very personal and detailed conversation, we discuss some of the major risks that Nigol sees in how investors are perceiving skill and alpha with some of the large hedge funds today, what he does to differentiate himself from these risks, and how daily meditation helps him see the world with clarity, which allows him to focus on continuing to build a solution-oriented alternative investment firm. And for those of you who are new to the show, I just want to let you know that you can find all of the show notes, including a full transcript of today's episode, on the toptradersunplugged.com website. Now let's get on with part one of my conversation. I hope you will enjoy it. Nigol, thank you so much for being with us today. I really appreciate it.
Thank you, Niels.
Now, as I was preparing for our conversation today, I noticed a few really interesting things that I'm sure we'll have a chance to discuss today. But here are some of my initial thoughts. One is the fact that you have a long and, may I say, very solid track record in your original program, but the program itself is a bit different to many of your peers, which I found fascinating. Also, you seem to have diversified your business into other product types, such as an equity program, both hedged and long only, as well as a tracker index where you seek to deliver the returns of your CTA peers. And I would be tempted to say that your firm seems to be looking to find solutions for investors rather than being a purist in one particular strategy. And finally, I noticed that you actually started on the other side of the table, so to speak, namely as an allocator or investor into hedge funds and CTA. So that in itself is, of course, an interesting way into what you do today. So I'm really excited about all these possible topics that we can talk about today. But of course, before we go into too much details about your company and where you are today, I would really like if you could take us all the way back to the beginning, telling us your story and what led you to take this path. And also feel free to go back as far as you want and share how you met your business partner, Paul. And I'll be open here and say, I'm going to let you pronounce his surname because I don't think I'm going to do that justice.
It's Paul Skianians. So
thank you.
It's a Polish name, actually. So
okay.
Great. Thanks, Niels. So in terms of background, I guess I'll go all the way to the beginning. I guess I was born in Lebanon of Armenian descent.
Okay.
So I grew up, in Middle Eastern culture, but also within an Armenian family. So a lot of tradition and that sort of thing. And this somehow came into play later in terms of the way we look at the world, the stability of the world, etc. So we'll go back to this soon enough.
Fantastic.
At age 16, I came to the States, and due to the war in Lebanon becoming a little bit too intense, and went to college at Notre Dame to study electrical engineering.
Okay.
From there, came back to New York and went into consulting. I worked for Andersen Consulting.
Mm-hmm.
And at Andersen, I spent most of my time working at Salomon Brothers.
Okay.
Totally by chance.
Okay.
And from the engineering background, we went into more financial type of application of programming and modeling for mortgage-backed security, prepayment models and that sort of thing, completely by chance.
Sure.
So I became more and more interested in finance. Of course, I was, working downtown New York, and Wall Street was very impressive at the time. So I started really, doing a lot of study on my own. I started programming on my own, started designing models in 1991.
Okay.
And from there, decided to get a more formal education in finance. So went to Colombia Business School.
Mm-hmm.
During business school, I was mainly spending my time on programming and designing models and all kind of things like that.
And when you say models, I mean, just to put things in context, I mean, what kind of models were they at the very, very early beginning?
Funnily enough, way early at the beginning, before looking at trend following, I looked at volatility breakout models, which means much, much more short term, day trading, holding the trade 3 to 4 days per trade, that sort of thing.
Okay.
And it's only later on that I actually, started developing trend following models.
Mm-hmm.
I mean, it's kind of funny, but I used to read a newspaper called Investors Business Daily that was very kind of giving investors a lot of tools to evaluate different stocks using different measuring techniques, some fundamental, some technical. And obviously the fundamental factors were difficult to test, but the technicals, it was pretty easy to test and to program. So I got the data, I started developing a testing platform. And it's due to that newspaper really that I went into technical trading and designing models.
Interesting.
So
very
interesting. So for vol breakout, actually it was pretty early on. I guess at the time it was Monroe Trout and eventually Toby Crable and that sort of names that started using it. But
definitely.
I wasn't. Yeah. So. It started, during business school, I was interacting with all the professors at Columbia, and Columbia is more directed towards equity and fundamental, investing and that sort of thing.
Sure.
And I was going around with my models and showing this to the professors, and nobody was getting very excited. Let's put it that way. During business school, I also worked at Deutsche Bank and did value at risk for the U.S. bank. So over the summer and into the second year. So that was also still in the early 90s. At the time, value at risk was relatively novel.
Sure.
So came out of business school in 94. I had models ready to go to start a CTA.
Okay.
Short-term models, long-term models. You name it. I had already a platform to keep track of trades, download data, all kind of things.
Fantastic.
After business school, I still spent, rather than getting quickly going into the industry, I spent another 6 months actually still working on developing models. So it was 100% of my time was still dedicated to research at the time.
Sure.
Finally, at the end of 94, I by chance I got in contact with Victor Teicher, who at the time was running a risk arb hedge fund.
Okay.
He was looking for a trader And I guess he was impressed by my background, and he told me, listen, what you're doing is very interesting. I like it, but I need a trader. So why don't you join me as a trader, and we'll do your stuff down the line once there's time for it.
Okay.
So from going from a place where I was looking to raise money to start a CTA, next thing you know, I'm trading in a risk arb hedge fund.
Yeah.
Designing hedges for all kind of positions all over the world, and trying to reduce overall market risk and try to really isolate specific factors within the stocks that we were actually holding.
Sure.
And of course, we were trading risk arb globally, and really there was never any time to to focus on the CTA strategies.
Yeah.
So eventually I moved on. But it was a very, very interesting experience for me, because I was so used to trading in the direction of the price action.
Yeah.
And in this fund, we were actually trading very, very fundamentally driven, very value driven, sometimes in illiquid positions where we would, based on our buying, I was actually influencing the price. I mean, even in a small fund at the time. So it was, from a psychological perspective, it kind of like erased everything I knew about how to trade.
Sure.
And I realized that there's other ways. It really broadened my horizons pretty substantially.
Interesting, and sounds like great experience to get exposed to early on.
Definitely, especially that I wasn't looking for it.
Yeah.
I thought I was sure I knew what I needed to do, and it was like a straight line path. And somehow the detour was very useful.
Yeah.
I have to say.
Yeah.
So after that, I joined Western Capital.
Mm-hmm.
Western Capital at the time was a marketing firm, and they were looking, potentially they were interested in starting a CTA and to raise money for a startup for the CTA that I was looking to start. And I joined with that intent.
Mm-hmm.
And as we were preparing, somehow by chance, the opportunity came to start a fund of fund.
Okay.
And so I said, oh yeah, that shouldn't take too long. At the time, the industry was much simpler, and due diligence was not as sophisticated and in-depth as it is today.
Sure.
So we started a couple of fund of funds that allocated to all kinds of strategies, including CTAs.
Mm-hmm.
And I ran those fund of funds for a couple of years until I realized that I was getting sidetracked again, and left and started my own firm. Initially as a fund of fund,
Right.
and then in '99 a partner joined me.
Okay.
And we started a CTA called Enterprise Asset Management.
Okay.
Yeah. So
a few detours along the way.
a few detours, but I would say I'm very glad I went through those.
Yeah.
Sometimes not getting what you want is the best thing you can get, because long term, there's things that are very, very useful that we don't even realize that we don't know.
Definitely. No, I couldn't agree more.
So here we are. We're running a CTA and a fund of fund, 99, 2000, 2001. 2001, my partner and I decided to split.
Sure.
And I started Quest.
Okay.
Yeah, Paul had joined me in 1999 at Enterprise,
Right.
and we came in, and he decided to follow me here at Quest.
Fantastic.
And we hired the head trader of AHL at the time, Neil Hanover,
Okay.
and off we go. So our assets rose. I mean, when we started the Quest, we had about at Enterprise we started about 2-3 million of private capital.
Sure.
And at Quest we started with about 25 million,
Okay.
and our assets slowly grew to a first peak which was around like 650 million in assets,
Mm-hmm.
around 2007.
Okay.
In 2003, we actually signed an agreement to give 90% capacity rights
Okay.
to all our strategies to the fund of a large CTA, a very
Right.
well-known CTA.
Right.
And they allocated about 550 million to us at a peak.
Okay.
And we just basically ran money for them from 2003 to 2010.
Wow. Interesting, very unusual, and but very interesting, indeed. And maybe you can sort of, as a sort of a lead on to that. Just, I know we're going to talk a lot about more about the details, but just take sort of a jump and say, so how does the business look today? What kind of programs do you run, and sort of roughly what the AUM is as well?
Today we're managing about 760 million.
Okay.
Of that, there's about 80 million in our traditional CTA strategies.
Right.
Then we have the replicator has about 80 million as well.
Okay.
And then the rest is in hedge products, so equity hedge and fixed income hedge. I think equity hedge is around 450 million, and fixed income hedge is around 150 million.
Okay, fantastic. Yeah. And in total, how many different strategies or programs do you run?
We're offering the original program, which is the benchmark CTA strategy, the QTI, which is the replicator, equity hedge, fixed income hedge, and equity long. So I guess about 6 different strategies.
Okay, great.
And if you notice that most of the assets that we have today are actually in the new strategies,
yes,
which was kind of out of necessity, we had to develop them because in 2010 that large fund of fund had to redeem due to their own complications.
Okay,
we did very well for them.
Sure.
But as they redeemed, and we are in an environment where people are deallocating from CTAs.
Yeah.
And we said, okay, we need to raise money quickly, and what can we do? And realized that it was a question of fees, a question of more like the relationship between CTAs and the equity markets were not as clearly defined as they could be, et cetera, et cetera. So we defined these, different programs along the way.
Sure.
But we'll get into that.
Yeah, definitely. No, it's super interesting, actually. Very, very interesting. Now, normally I would go on and ask you a little bit about your business, sort of how it's structured. But before we do that, today I'd like to go a little bit of a different route. I want to talk more of a broad question, which I think is really important to many investors and perhaps managers may not be focusing on this enough. And that's really what people, when they look at track records, may be perceiving as the value they get when they look at a manager. But in reality, it may not be anything to do with skill or alpha. Some people might say that, we've seen a lot of sort of style drift, and, because deep down, it's often rooted in the managers that over time they change their strategy and their style. And I think maybe the last few years we've seen quite a big, shift in that sense. So I'd love to hear your opinion about this and where you see the dangers may lie of an increased correlation between the so-called alternative strategies that are designed to protect investors against traditional investment when they have trouble, and the traditional asset classes themselves.
Sure. Great question, actually, and I think that there's some pretty interesting angles on this, especially looking at it from a CTA perspective.
Sure.
So first, I will cover the CTA industry, and then I will take it more broadly within, I think, within the hedge fund universe.
Sure.
So today, the CTA industry can be replicated with a very simple model, such as 10-day to 100-day simple moving average crossover strategy.
Okay.
So the most basic strategy you can imagine, you apply it equally to 4 sectors without any other optimization. You already have something which is 70% correlated to the CTA industry, which is outperforming about 3 to 5% a year due to fees.
Right.
So about 10 years ago, the CTA industry was looked at as a big pool of skill-based returns. Today, it is more and more apparent that at least 90% of those returns are really very easily replicatable, and the techniques of replication are broadly available.
Okay.
This is step number 1. So starting with that, saying that the industry can actually be replicated so easily. Now, if you start looking at the offshoots of this industry, so if you look at the managers that have raised money in the recent years, and they have grown from into the 20 billions and tens of billions and 5 billions, et cetera, you will see that they actually have exposure to certain factors, and most commonly, the factors that they are exposed to have been risk-on strategies, so strategies that are correlated to the equity markets in one way or another.
Right.
So over the years, we wrote 3 research pieces that actually explore the specific, not looking at the CTA industry as one broad basket, but saying specifically what are the factor drifts that could actually affect the returns of CTAs. And so I will list those factors. I'll go over them quickly and
Sure.
give you an opportunity to see what kind of impact these factors can have. So suppose you're investing in the S&P 500 and you see a mutual fund which is up, let's say 20% more than the S&P. You say, wow, the manager is a superstar. Or you say, well, he's actually invested in microcaps and they've done very well this year. So
Right.
at this stage, considering the transparency has changed the view of the CTA industry, it's important for the investors to go one step beyond and become aware of the sub-factors and their impact, because these sub-factors that have been performing very well have very different characteristics during equity corrections, as we will cover.
Okay.
So let's look at them quickly. I would say the first factor is a sector optimization. It means CTAs have been allocating more and more to fixed income because fixed income has performed very, very well in the last 20 years.
Sure.
Now, it happens to be that fixed income is also the most liquid sector, and therefore CTAs, as they're growing, even if it was not a research-driven optimization, the allocation issue and the liquidity issue forced them to allocate more to fixed income. So allocating more to fixed income could actually improve your Sharpe ratio over the last 15 years by 40%. So if you look at a basic model, the 10-100, which we'll take as the benchmark for the CTA industry,
Sure.
and you increase the fixed income sector allocation, your Sharpe ratio would go up by 40%, which is already very, very substantial.
Sure.
So that's factor number one. Now, as a side note, fixed income has been negatively correlated to stocks, which means during equity corrections, it's provided substantial returns to CTAs. I would say the majority of returns that CTAs have generated in the last 15 years during equity corrections have come as a result of their fixed income exposure.
Yeah.
Okay. So that's factor number one. So sector optimization, and there's a potential for substantial improvement in Sharpe ratio due to an increase in allocation to fixed income. Factor number two is long versus short. It means if you look at the returns of CTAs over the last 20 years, you will see that over 90% of the returns of a basic CTA strategy come from the long side. It means long trades.
Sure. Yeah.
Short trades have made almost no money. A couple of periods, around 94, 01 to 03, very small returns, and then 07 to 09, some pretty good returns there. But overall, shorts are almost flat.
Yeah.
Now, effectively, this means that the CTA industry is not so different than the buy and hold, just running a buy and hold strategy on the same basket or the same portfolio that CTAs trade. And this is very surprising to most. You're saying all these trading models, et cetera, are really minutely different than the buy and hold on the same markets. So we're saying the longs, if you traded longs only instead of trading longs and shorts, you would have improved your Sharpe ratio by 80% over the last 15 years.
Okay.
Now, again, assume you're a large CTA, and here you have higher transaction costs due to your size.
Sure.
And shorts are basically at this stage a straight line down. Due to the higher transaction cost, you would say, why am I trading shorts? Let me focus more and more on the longs. So again, as you grow in size, this factor is something which is imposed on you.
Sure.
And it's improved your Sharpe ratio by 80%. So we see again the potential for self-reinforcing feedback loop where the managers that are growing in size are forced to allocate to factors which have done very well.
Yeah.
And I would argue completely by chance.
Sure.
So the third factor is the time frame. Over the years, and we've shown this in our research pieces, over the years, CTAs have had to increase the time frame that they use for their models. Now, you can use 10-100. It used to be in the 80s and 90s that 10-day to 40-day simple moving average was the classical trend following strategy. Mm-hmm. And eventually, in the 2000s, the first decade of the new century, it became 10-100. And today, if you look at it, if you do a factor analysis, you will see that CTAs are trading timeframes as long as 10-day to 500-day moving average, so much more long-term.
Wow.
Here we're talking where the average days per trade used to be 10, 15. Mm-hmm. Now we're talking 100 days, 150 days per trade. If you don't count rolls.
Sure.
Okay. Now, just to give you an idea of how valuable it would have been to trade this 10-500. To begin with, the equity curve of 10-500 has not even flatlined in the last 5 years, such as the rest of the CTA industry.
Yeah.
So you look at 10-100 or 10-40, you see in the last, since 2009, those models have not made any money. 10-500 is in a straight line up without any interruption.
Sure.
So if you optimize the portfolio and add 10-500, you will have the potential to improve your Sharpe ratio by 70%. Instead of 0.5, we're talking 0.8 and that sort of level, which takes you to the superstar level immediately.
Yeah.
So these are already three factors which have improved your Sharpe ratio by 40%, 80%, and 70%. Mm-hmm. And there's no skill involved yet.
Well, sure. I'll let you go on. I've got some observations, of course, but I'll let you go on.
Okay. So a third factor that we talk about in our research pieces is the fact that CTAs make money during trends, but the biggest factor that explains their returns and the value-added aspect of their returns is the fact that they make money when the volatility is expanding. Sure. So when you put on a trade, a trend-following trade, you're making money because of the trend, but you're really benefiting mainly when the vol is expanding as the trend starts.
Sure.
Once the trend is established, your returns start to correlate to equities, and they start to correlate to fixed income. Mm-hmm. There's no more alpha relative to the traditional portfolios. Okay. So now, over the years, we show that CTAs, this character of benefiting from the volatility expansion is called positive skew. Basically, when you have a surprise, it tends to be positive on the returns.
Sure.
And the opposite, negative skew, is when there's a surprise, it tends to be more negative. So now CTAs over the years, in order to generate higher Sharpe ratios, have taken profits faster and bought the corrections within the trends more and more. Mm-hmm. Very, very substantial. First, this improves your Sharpe ratio, but also it makes you less capable of benefiting during volatility expansions.
Can you explain that a little bit? If just take a few steps back and explain that again. I'm not sure I fully understood what you meant by they bought the drawdown.
Okay, so let's say you're running a simple trend following model such as 10-100, and you size your position based on volatility.
Sure.
Now, what I was saying is the most profitable trades for CTAs are the trades that were entered when the volatility was low.
Sure.
And then expanded once the trade was in place. Mm-hmm. So now, the danger of that is that after a trend is well established, the volatility could have doubled versus when you put the trade on.
Sure.
And now your risk in that specific market is twice as what it used to be from a VAR perspective.
Sure, all things being equal, that you haven't moved your stop and so on and so forth.
The stops for the typical trend following models are pretty far away. It means after a trend, they could be 2 weeks, 3 weeks away from you.
Sure.
So if you replicate the industry, I would say stops are irrelevant. It means you don't have to have stops in the market. You have trailing stops. I mean, if the moving averages cross, you trade. But you can trade market on close. You can trade once a week. You can trade once a month, as a matter of fact. And your performance would not be very different.
No.
So what we're saying is, trend followers classically used to benefit from the acceleration. So price is moving 1% a day, and then the trend is established. Now this market is like a really hot market, and now that market is moving 3% a day. The typical CTA, classically, you're going to say this is a real trend, and I'm going to be exposed, and I have much higher exposure to this market. The vol has expanded, and typically the vol expands when equities are going down. So when the vol is expanding, CTAs are expected to generate high returns. Now, let's say CTAs decided that they don't want to risk as much when the vol is expanding, and they want to make money more consistently. What they would do is they would reduce their position size when the vol of markets expanded within the trade. And when the market also is retraced, so you're in an uptrend, the vol expanded slightly, you're going to reduce your position. And when the vol compresses, which means during a correction, they would add to their positions. So they're in an uptrend, picking bottoms and selling rallies. The benefit of that is that they now have a constant volatility portfolio. It means they look at their VAR and they're expecting 15% annual volatility every day. The downside of this is that you've lost your positive skew. You've lost your ability to generate high returns during equity corrections. Now, this is a basic. So factor number 4, I'm calling it, just mean reversion broadly. Mean reversion means you're selling rallies within the trend and buying the dips within the trend. Now, I want to take this one level beyond and go into the specific example of buying the dips in the financials. It means you can very easily use a model which buys the S&P if it's down 3 days in a row. And because you're expecting it to rally. Same thing in fixed income. Now, we can potentially make this model available for listeners to the podcast, but just to give you a sense of this. So if you bought the S&P, if it's down 3 days in a row, and you exited when you make, so sorry, I'm going to get a little technical, but
no, that's fine. I'll stop you if it gets too technical, but we'll take it step by step.
It's a pretty simple model. So you buy the S&P on the third down close. You take a profit if it makes half a daily range. So you bought it at the close. If it goes up half a daily range, you take profits.
And so the average to range, over what period are you looking at here?
Over 50 days, let's say. Not very relevant, but let's say over 50 days. And you have a stop loss 2 daily ranges away. This model, over the last 15 years, have had a Sharpe ratio of about 1.2. Even during equity corrections, this model you can't even tell that 07 to 08 happened. So there's in today's world, which is driven by central banks providing liquidity because markets are driving the economy rather than the other way around. There's been a preponderance of mean reverting strategies in financial markets with again, I'm saying Sharpe ratios over 1 and without any skill. This is a model which I'll provide to the listeners. And CTAs are more and more including such strategies which are buying the dips in financials as a way to generate alpha. Okay. So again, I won't get, the numbers are really wild, but this type of strategy improves the Sharpe ratio of the typical trend following model by 130%.
Substantial.
So very, very substantial. So I'm just giving you the potential things that CTAs are introducing into their portfolios that are substantially changing their characteristics with no skill, which investors have to be aware of if they want to really pick up the CTA with real skill after that.
Yeah. No, it's very, very important. It's very, very important.
There are 3 more factors that we say CTAs have introduced. One is fixed long equity exposure.
Sure.
So if you look at the rolling correlation of the BTOP, which are the 50%, the largest CTAs that control 50% of the assets of the CTA industry.
Yeah.
You look at you take out their trend following component through a factor decomposition. The residual returns rolling correlation to the S&P today is 70%.
Okay.
So we're not saying that they're trading equities and they're making money on equities going up. We're saying they have fixed long positions in equities.
Yeah.
Very different. Now, adding a long position in the S&P, just to keep it simple, over the last 15 years would have improved your Sharpe ratio by 20%. And again, going from a Sharpe ratio of 0.5 to 0.6 takes you from average to almost superstar. I would say at 0.7 you're like superstar level.
Sure.
So I mean, this is how dramatic these factors are.
Yeah.
Now, same factor is if you short the VIX. So instead of going along the S&P, you can short the VIX, short volatility, which has the same effect as being short puts on the,
underlying. Sure.
Exactly. Then you could actually have improved your Sharpe ratio by 90%.
Okay.
Then you have the typical carry models.
Yeah.
Which improve your Sharpe ratio by 18% if you optimize them.
Okay.
And then you have now today your CTAs are adding credit type strategies into by exposure to credit swaps and that sort of thing, and those would improve your Sharpe ratio by about 80%. Okay, so here we're saying there's 7 factors which are absolutely not skill based, which are highly correlated to the BTOP, which means over time you can see that the BTOP is steadily increasing its correlation to those 7 factors, and all 7 of those factors are things which reduce the ability of CTAs to hedge equity corrections.
Sure.
So CTAs are getting better and better by introducing these factors on a standalone basis, but they're becoming worse and worse at hedging equity corrections.
Sure.
And investors haven't picked up those factors out of the CTA returns yet, and they're therefore focusing on the CTAs that have the most of these factors. Okay.
Very, very interesting, incredibly useful, and very, very insightful. And people should really pay attention, even though it might sound very technical. But this is important stuff. But I have the same observations, maybe not so eloquently sort of described as you do. But I agree with the overall conclusion of what you're saying. Now, the question here. And this is interesting, and it's particularly interesting and very topical because David Harding from Winton was on CNBC, I think yesterday or the day before, in an interview where he was obviously being asked about equities and so on and so forth, and he kept stressing the point that they may not be a hedge if equities go down. They may be, but they may not be. And so from the way you describe things, I sense that you, and correct me if I'm wrong, that you are saying that a lot of these managers that are doing these new things are doing it to compensate for size. Would that be a fair statement? Or do you think they're doing it not really because of size necessarily, but simply because of trying to introduce some more stability in their returns?
I would say both, and the fact that they don't have to make a choice between one and the other is even a stronger or an accelerator for these optimizations. So size, definitely you would have to make these optimizations, but also these optimizations have worked extremely well and are working better and better as time goes on. In the last 5 years, shorting the VIX is like, it has a Sharpe ratio of, again, over 1, just a simple strategy. So it's numerical and it's size.
Yeah. I mean, obviously, I would love to have David Harding come on the podcast and discuss this issue instead of us trying to discuss it, because obviously there is some reference to people like Winton who've been very, very successful, stabilized the return, reduced the volatility, and now coming out saying that they may not be a hedge when equity markets go down and so on and so forth. But let me be devil's advocate here, even though I agree with what you're saying. And that is, we say it's not due to skill. But what if the skill is that they actually introduce these strategies at a time where they would be beneficial for their returns? But it's not to say that they won't deleverage or de-emphasize these strategies later on at a time where maybe the trend following strategy should have more weight, because we know, and we have to accept, perhaps with your firm as one of the few exceptions, but we have to accept that for trend following strategies, it's been a really difficult and tough environment. And that obviously goes back to the fact that volatility has been decreasing, and generally trend following strategies make money from the expansion of volatility. So I just wonder, I mean, some of these firms, they have 150 PhDs and they have to do something. And if maybe they actually came up with this, observation saying, listen, we should, increase some, risk exposure to these type of strategies, because as long as the environment is as it is and we're not detecting any changes in the data, they will help. I don't know. I'm just putting it out there.
Okay, great question, Niels. Let me give you my angle on it.
Sure.
So, first, broadly speaking, I would say people have, or it's been basically predicting factor turnover has been something that I want to say less than 1% of fund managers have been able to do. Like, it's not something which is broadly done.
Sure.
Nobody, even the macro guys, the Louis Bacons, et cetera, at the time were really truly exceptional managers, today cannot tell you where the returns are going to be, what factor. If you can actually predict what sector or where the returns are going to be, your Sharpe ratio would be 3 and above.
Sure.
Now, going back to the CTAs, so you're saying, is it possible that these PhDs have found a way to tell you when you should exit risk on trading and go into risk off trading? Well, I would say it's very highly, it's very unlikely. The reason I say that is because we've had an example already of an equity correction after these factors were introduced into the CTAs. So these factors really started peaking into the large CTAs around 2003.
Right.
2004, 2005, when the vol went really low, interest rates went really low, and the carry trades became highly contributory to a CTA portfolio. And then here comes 07 to 09. So you'd say, did these PhDs, were they able to get out of the risk on trading and go into trend following at the right time? And if you look at the returns of these large CTAs or the BTOP 07 to 09, relative to the replicator that has a beta of 1 to them. So you replicate the BTOP, with a certain, with its beta, etc.
Yeah.
You see that 07 to 09, the replicator over the 2-year period made about 96% in return, where the BTOP was up about 17%. So I'm saying that the CTAs that introduced these new styles into their portfolio underperformed their replicator by 80% in absolute return.
Yeah.
Over a 2-year period.
Same volatility between the two?
Beta of 1. Okay. Absolutely. Okay. So if you look at the way the BTOP had performed relative to the replicator before, it has about 75% correlation, and they're completely in line. Now, so I would say that there already was one major test, and they failed majorly.
Right.
At a period which was really critical. So now they're telling you, we're not going to give you a hedge. We really don't care. Now today we're a hedge fund. We're not a CTA anymore.
Sure.
That's a fair choice, but investors should know what they're getting.
Yeah. No, I agree. And as I said, I think it's really super important, and something I probably think is something that you have not only thought a lot about, clearly, but also has sort of shaped the way you do things, which I'm sure we'll get to very shortly. But I want to go back and talk a little bit about, you have these 6 strategies. You have, almost $800 million under management. How big a team does it take to run a business like that? And how is it structured? And how do you balance between what to do in-house and what to do, by the means of outsourced, providers?
We can cover that. There's one point I'd like to make about those factors.
Sure.
And it's that the hedge fund industry, like a lot of these factors can be understood correctly within the CTA space and within the hedge fund space if people measure risk by measuring tail risk rather than measuring volatility or beta to the stock market. So most hedge funds and most CTAs today are generating numerical alpha to their benchmarks, but the ones that are generating numerical alpha are doing so because they're taking more tail risk than their peers.
Right.
Not because of skill.
Sure.
And that's something we went into our second research piece. So, and CTAs are doing the same thing. They're converting positive skew for negative skew with higher Sharpe ratio. So this is something very, very important.
Sure.
So alpha does not equal skill. Alpha equals skill sometimes. Okay.
Sure.
So going back to your question in terms of how can you run 6 strategies? What kind of infrastructure is needed?
Sure.
I would say the most important thing to run, a firm like ours, infrastructure is needed, but the most important thing is to have a clarity of direction in order and a clarity of purpose. If you're trying to create a product that does everything, it's never the infrastructure is never going to be enough.
Yeah.
So the most important thing is to start with a clear mind in terms of what you're trying to offer and to stick to that no matter what the market conditions are. Now, infrastructure-wise, because what we do is based on automation.
Right.
So we're saying, as a starting premise for CTAs, we're saying the human mind is not equipped to make ideal decisions in the financial markets, because the financial markets are there to compensate for what feels good. Not so basically, when you put on a trade that feels good, you typically lose money.
Sure.
And the way you, in a way, have to be detached from what feels good, from what everybody is thinking. And in a way, you have to be contrarian, and you have to put on a trade that nobody wants. And the human mind is not designed to make such decisions.
Sure.
It's designed to think as part of the crowd.
Yeah.
So now we're saying we're going to rely on models. We're gonna decide. We're gonna program the models and tell them what to do. But then we have to trust them 100%. Now that gives you, when you understand how distant you need to be from the models, it gives you the ability to run with a relatively small team a lot of different strategies, because once they're programmed, as long as they're not over-optimized, you can give them life and let them live.
Yeah.
You don't have to be thinking about them every day, whether I need to re-optimize the factors, et cetera, et cetera. So it's a question of, you have a certain degree of mental space. We believe that mental space is most well spent during the research and the design of the strategy. But then if the strategy is over-optimized, then it's going to take too much mental space to maintain. And therefore, that's not a place that we go.
Sure.
Okay. So now infrastructure-wise, today, more and more things are becoming commoditized.
Yeah.
Whether it's the accounting, the execution, et cetera, et cetera. Now, for us, we're pretty good at programming, et cetera, et cetera. So we've actually kept in-house the order management system, order execution system. Obviously, the trading strategies, we do everything in-house, so we don't outsource. So it's a lot of the admin, the back office, and all that can easily be outsourced. And today, it's a commodity, and the price spread between different providers is really minimal. So I would say it's like a no-brainer.
Sure.
Over time, it's now that the replication is coming into play, I would say that you're going to see that some strategies are going to become commodity as well. You're going to have 5 different firms offering, what used to be, let's say, a small cap mutual fund in the CTA world is going to be, the sub strategies are going to become available exactly the same way through different providers, et cetera, et cetera. So the industry is very mature compared to where it used to be 20 years ago and 10 years ago and 5 years ago even. But with 9 people, we're able to, I would say, out of the infrastructure that we have, we can service clients. We don't have that much of an infrastructure in terms of on the asset raising side.
Sure.
Because we focused on servicing one client for 7 years, today we have about 5 clients that account for 99% of our assets.
Sure.
So we're much more focused on client servicing, reporting, and that sort of thing, rather than asset raising. And as such, I would say our infrastructure is pretty tight.
Sure.
Yeah.
But also still, it allows you still to grow as long as you sort of keep that focus, because as you say, automation takes care of the day-to-day stuff. So very interesting. Now, looking at the track record, and I think we'll sort of probably focus, if I may, focus on the original program. We may talk a little bit about some of the other stuff, but if we focus on the original program, because it has the longest track record, going back to sort of May 1999 when you started, and all the way through to now, when people nowadays look at track records, they tend to believe that, okay, this is what I'm going to get going forward. But that's obviously not true, because most programs go through evolutions and changes over time. But how would you say people should look at your track record when they look at it? Has it is it very different? Does the program look very different today than it did when you started? And when was these big changes? When did they occur?
So here again, Niels, what's really important is to know, relative to the benchmark, what bets we've made, what factors we've exposed ourselves to over time, and whether our philosophy has changed over time. Nobody can predict the returns, but if they can know the sub-factors that they're exposed to, typically they're pretty happy, because they can build a portfolio in the way that they want. And I think that's really critical.
Sure.
So what we've done over the years in the original program, we've had the philosophy of, we're looking first to be, a trend follower. It means, we're looking to correlate to the CTA indices.
Right.
But we also want to generate a lot of alpha. So we've generated about 7% of annual alpha to the BTOP per year since inception. Now, philosophically, that philosophy has not changed. So our alpha is there. So we're not looking to be a replicator in the original program. We're looking to generate alpha, and we want our alpha to come from positively skewed sources of returns.
Okay.
Which means we don't want to be bottom picking equities and with a Sharpe ratio of 1.2.
Sure.
We don't want to be allocating more to fixed income. We don't want to be going long equities. We don't want to be shorting VIX. We don't want any carry. We don't want any credit spreads.
Sure.
Okay, so now how those concepts have been expressed over time has evolved substantially. So broadly speaking, something which is really important and like I would say critical for the firm's survival is that today 9 sources of alpha out of 10 are negatively skewed. It means they involve mean reversion, they involve being exposed to risk on type of trades, and we disqualified those immediately at the forefront.
Okay.
So now you're left with very few research ideas, but those are typically things that are more difficult to exploit.
Yeah.
Due to transaction costs, but we're pretty good at that, at controlling that, and that's how we've generated this alpha. Now, the benefit of positively skewed sources of alpha is that they are more stable when the market regime changes. So if you tell me, I have a strategy which is going to buy the S&P when it's down 3 days in a row because the S&P never goes down even 2 days in a row now. It's great, but if there's any slight shift in market regime, then it's a very, very large vulnerability.
Sure.
So the track record of the original program, the philosophy has not changed, but the way we've expressed this long volatility or long tails type of bias that we have has changed over time. And I'll give you examples. First, basic strategy. We're not looking to go into... first, our days per trade is about 7 days per trade.
Okay.
Where the typical CTA today is probably around 30 days per trade. The reason we pick the shorter time frames is because that's where you can generate alpha, and that's where you have the most positive skew. Okay. So if you want to benefit from tail events, so large increases in vol, 7 days per trade on average is where you have the most expansion in vol.
Okay, interesting.
When you go to 30 days, and now people are going to 60 days, and so the larger CTAs are of course trading more long term. The more long term you go, the less positive skew you generate. Okay, so we're looking for vol expansion And vol expansion happens when you cannot predict when, but you can predict the size of it based on its long-term average. So typically, you would look at the volatility of the market in the recent past and compare it to a longer-term past. And if the recent volatility is much lower than the long-term volatility, you would say there's been some sort of vol compression. Now, from this type of environment, a trend following signal in many different time frames is going to give you much more positive skew and much more alpha than the typical what's going typically today in the industry, which is to instead buy the dips. To the vol has expanded, let me put on the mean reversion trade. So we're still looking for the vol compression, although the vol keeps going down and it's becoming more and more difficult because of all the central banks basically constantly providing liquidity.
Sure.
But even when in a low vol environment, we're able to generate returns because the vol has spikes.
Right.
So the markets are pushed very far away from equilibrium, and they're there with very low vol. But when something goes wrong, then the vol expands much more than it used to. So even last year, when the vol was extremely low and coming down, we were able to be up in the original program about 16% or so, because there were 4 small spikes in volatility. If you look at the VIX, for example, and in those 4 periods, that's when we made about 4% in each and ended up 16% on the year.
Okay.
So now the track record over time, vol expansion is measured very differently today than what it used to be when we started. When we started, you could look at the 4-day volatility compared to 50-day volatility. If the 4-day volatility was less than the 50-day, you would say, okay, I'm going to take whatever, this signal or that sort of thing.
Right.
Today, we're looking at things in a much more complex way. For example, we measure volatility differently when the market is making new lows and new highs than when it's in the middle of the range.
Right. Okay.
There are a lot of people who are protecting price levels, mainly central banks and other option sellers and that sort of thing. So when a central bank sees, for example, dollar yen go below a certain level, it's going to intervene, and it wants to intervene in a way that minimizes its cost, which means it has to trade as much as possible, as quickly as possible, and to create a dramatic reversal. So if you measure the volatility at the tails, independently of the volatility in the middle of the range, you have a lot of information about the character of the market. That's an example of going from a basic volatility measure to something which is much more pattern-based and much more relevant in today's world.
Would you say that volatility is almost more important for you than price, and when in identifying trends?
Absolutely. A price, as I said, trends which are so. The typical approach, it seems from a replication, in today's world, you have a trend following model. Everybody starts with that. And they say, now, how can I improve it? I want to pick the trades. Typically what they do, I want to pick the trades that have the highest Sharpe ratio. As you do that, you're looking for those clean trends. Those clean trends don't have vol expansion in them, and they're highly correlated to the stock market. They're highly correlated to fixed income.
Sure.
For us, we're not looking for the trend. We're looking for the correct volatility setup. We're looking to generate alpha, and it needs to happen very quickly in time. That's only available if the vol accelerates. So yes, volatility is the most important criteria behind our setup.
Okay.
Yeah.
Very, very interesting. Now, tell me a little bit about how you then constructed the original program, so to speak, in terms of the kinds of models you use, and maybe a little bit about I'm sure they're not all the same time frame, but how have you sort of, from an overall point of view, constructed the program?
So in terms of where we are today, we're trading anywhere from all the way from day trades to some long-term models that can stay in a trade forever. But about 75-80% of what we do is time constrained, which means after a certain amount of time we exit the trade no matter what.
Okay. Because
the alpha is not there anymore, and we expect other CTAs to be there, and therefore we say there's no point being here. The trade is not as valuable.
Yeah.
So the concepts that we use are utilized across, again, multiple time frames. The key is measuring volatility, but volatility is not the right term, really.
Okay.
So markets have memory. It means you look at a trend following trades, and this is not a random walk. There's a serial correlation which is way over zero, and then the market stops from the trend and it goes into a negative serial correlation type of environment. So it's not that the market overall shows zero autocorrelation day to day, but it's actually positive sometimes and negative sometimes. Now, what is the impact of that on volatility? If you're measuring volatility in a trend, like from a VAR perspective, the vol can go to zero. If you go to credit market where you're getting paid a certain amount of money every day, the vol is zero.
Yeah.
Now the risk is definitely not zero.
No.
Okay. So conceptually, our philosophy is that investors are not pricing tail risk correctly because they're using volatility as a measure of risk, and they're over allocating to markets that have extreme tail risk. Being confused, thinking that they're getting skill. So we want to maximize the exposure to that. That exposure happens in the short-term time frames, for example, by looking at the volatility at certain times of the day, which is highly predictable in terms of the future. So, okay, let's
take a concrete example. Let's say, if you can, let's just try and visualize it really for the listeners.
So, I will go back to a model which says, compare the 10-day volatility as measured. Let's say compare the 10-day range to the 50-day range. When the 10-day range is small in size relative to the 50-day range, then take trend following signals.
Right.
Okay, that's one example. Now, it's not really the range. I mean, we're looking at volatility from a statistical way. It means volatility should be normal, and when there's something which is missing in that normality, we're looking for it to come back with a vengeance for the market to become stable again. So if the market only goes up, you would expect a sharp correction. If it goes up without noise, you would expect the correction to be much larger than if it goes up with noise.
Sure.
Okay, so you're looking for the pattern of volatility to be symmetrical and healthy, and so we're looking. I give you the example from an absolute level, 10-day range versus 50-day range.
Sure.
But instead of looking at the range, we're looking at the peculiar characteristics of volatility. I give you the example of the volatility at the ranges versus the volatility in the middle of the range.
Right.
Anytime you have big differentials in different aspects of volatility, there's going to be something which is going to rebalance the market. So
if I understand you correctly, what you're saying is that first you have some kind of volatility filter that determines what kind of model you want to trade.
The models are, I mean, the models, again, you can replicate with moving averages. Typically, most of our trades are based on stops. So again, it's not channel breakout, but it's based on stops, and it's different than.
Because you need a trigger. I mean, it's fine to say that if one volatility level is below another, then do trend following. But you still need a trend following trigger somehow.
So the trigger, you're going to be okay if you use moving averages. You're going to be okay if you use channel breakout.
Okay.
So why don't we, for you to have a complete model, I would say only trade when the vol has compressed, then trade a 10-day channel breakout.
Okay.
Finish.
Yeah.
That's one model.
Yeah.
Now, the way we do it, we're using different entry levels.
Yeah.
Than the channel breakout, but this would give you something which is very different than what the market is doing already.
And you would add a time stop to that trend following model, even though it's trend following, and usually trend following, implies that you let the trade run. You would actually apply a time stop as well. Absolutely,
because we're looking to maximize the amount of alpha per unit of beta. Beta is easy to get, so we don't have an issue with that. So we're looking to maximize the alpha. We say, depending on the setup. So let's say we're looking for a vol compression where we're looking for the market to correct within a long-term uptrend and the vol to compress, expecting a continuation of the trend with a vol expansion. That's a type of trade where you're going to generate some alpha for 2 or 3 days, and very quickly trend followers are going to catch up with you. Okay, so you have to say exit after 3 days, for example.
Sure.
Now, on the other side, let's say the market is in an uptrend, and the vol has acted in a very there's an extreme amount of randomness in the market. So randomness. How can I? Let's say the serial correlation of the market has gone very negative after a big uptrend. And now you're expecting that if a correction comes, it's going to be very aggressive. Okay, so now that type of market, if that correction happens, you can stay in a trade much longer because it's going to take trend followers 2 weeks to catch up with you.
Sure.
And therefore, for 2 weeks, you're generating alpha. So every setup condition has embedded in it a time after which the beta on average the alpha switches to beta.
Do you trade these same, I guess I have many questions actually. It's very, very interesting. Firstly, I wanted to ask you, how many different models would you say that you run? And does each model get applied to all the markets in the portfolio?
That's very, very important, yes. Based on the stability of market regimes in today's world, within the CTA space, I would say that not applying models to all markets is a guaranteed over-optimization. Within the CTA space in today's market regime, I emphasize. So I believe that, yes, I mean, if you hire, you got to be really careful about designing models that work on individual markets.
Sure.
And you got to say a lot of prayers when you use them. Okay?
Yeah.
So, yes, we apply models to everything in the portfolio. Now, in terms of how we build the original program, we have about, call it 5 different concepts, which are applied in 2 or more different time frames.
Okay.
They're exactly the same concept.
Okay.
One could be the skew of the market. One could be the volatility compression. One could be the volatility at the extremes versus the middle of the day, that sort of thing.
Sure.
So it's the same concept. The entry conditions are and the time frames are different, and these things are concepts which survive, across markets and survive across time frames as well.
Fascinating. Now, this is complex stuff. I mean, for you to explain this, this is not, a lot of people will have difficulties in sort of getting their head around these type of concepts, because it's a little bit more than traditional trend following. You buy when the price move up and you sell when the price move down, and so on and so forth. But what I wanted to ask you, because you mentioned in the beginning of our conversation that your upbringing in Lebanon actually influenced the way you design your systems. So now I want to try and bridge that gap between these very complex models that you just described and your upbringing in an inherently unstable environment. How does that work?
Thanks for the interesting question. Well, you see, we see the world based on our memory of what it's supposed to be like. It means most people see the world based on their own filters of reality, not based on how it is.
Right.
Okay. So I have filters. People who grew up,
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.